Have you ever felt like something is wrong with the economy, but every headline tells you everything is fine? Have you ever watched your grocery bill climb every single week while experts on TV say inflation is under control? Have you ever wondered if you are the only one who feels like the ground is shifting? Like something bad is coming and nobody is saying it out loud? You are not imagining it. And by the end of this video, you will know exactly what to look for. There are 3 hidden signs of market turmoil happening right now. Signs that appeared before every major crash in modern history. And the reason you do not hear about them is because by the time they make the news, it is already too late. Right now, someone is looking at the same economy you are, same headlines, same grocery prices, same gas station numbers, but they are quietly moving their money, shifting their strategy, preparing for what most people refuse to see. And when the quiet crash becomes loud, they will be protected, while everyone else is asking how they missed all the warning signs. The difference between those two people is not luck. It is information. So if you have ever felt like you are missing something everyone else can see, stay with me, because you are about to see everything. And once you see it, you cannot unsee it. Let me tell you about Daniel, 38 years old, works in tech, has a 401k, watches the news every morning before work. In October of 2007, Daniel felt uneasy. Housing prices seemed crazy. His neighbors were buying second homes with no money down. But every financial expert on television said the economy was strong. The stock market was at record highs. So Daniel ignored his gut. He stayed fully invested. And 12 months later, he watched half his retirement disappear. Here is what nobody told Daniel. The warning signs were everywhere. But they were not on the evening news. They were hidden in bond markets, in lending standards, in data that financial institutions see, but the public ignores. And the same pattern is happening right now. Different details, same structure. Same quiet signals screaming that something is wrong. The question is not whether you should pay attention. The question is whether you will recognize the signs before it is too late. So let me show you the 3 hidden signs. The same ones that appeared before 2008, before 2000, before every major market collapse, and what you can do about them today. Hidden sign number 1, the yield curve inversion. And if those words mean nothing to you, that is exactly the problem. Here is what it actually means. When short-term government bonds pay more interest than long-term bonds, the market is sending a message. That message is simple. Investors believe the near future is riskier than the distant future. They are bracing for impact. And here is the part that should make you pay attention. Since 1969, every single time the yield curve inverted, a recession followed within 6 to 18 months. Every single time. Not most times, not usually, every time. The yield curve inverted in 2022. And it stayed inverted longer than any period in modern history. But here's the thing. Nobody talks about this on the news because it is boring. It does not make good television. So while everyone is focused on stock market highs and jobs reports, professional investors are watching the bond market because bonds do not lie. Stocks can be propped up. Headlines can be spun. But the bond market reflects what big money really believes. And right now, big money is not confident about the next 12 months. This does not mean sell everything tomorrow. It means pay attention, adjust your strategy, protect what you have built. Now, let me show you hidden sign number 2. And this one is even more dangerous because it is hiding in plain sight. Corporate debt is at 47% of GDP. That is higher than it was in 2008 before the financial crisis. Here is what that actually means. Corporations borrowed trillions of dollars when interest rates were near zero for over a decade. They used that cheap money to buy back stock, pay dividends, and fund operations. Not because business was great, because borrowing was easy. But now interest rates are higher, and all that debt is getting expensive. Companies that were barely profitable at 2% rates cannot survive at 7%. So what happens when those companies start defaulting? When they start laying people off to service debt payments? The same thing that always happens. The stock market realizes those companies were overvalued, and prices crash. And this is the part nobody talks about. The debt crisis is not coming. It is already here. Companies are just hiding it with accounting tricks. Meet Jason, 42, works in logistics. His company is publicly traded, reported record profits last quarter. But Jason sees what shareholders do not. His department is understaffed. Maintenance is being deferred. Contracts are being renegotiated down. Because the company is spending $18 million a year just on interest payments. Money that used to go to growth now goes to banks. And Jason is not alone. This is happening across every industry: retail, tech, manufacturing, energy. The cracks are forming. The question is whether you see them before the wall collapses. So, what do you do with this information? First, look at your own portfolio. If you are heavily invested in companies with high debt loads and low profit margins, you are exposure. And exposure means risk. This is not about selling everything. This is about being strategic, being intentional, protecting what you have worked for. Now, let me show you the third sign, and this one hits home. The consumer is breaking. And I am not talking about headlines. I am talking about real people with real bills. Credit card delinquencies are up 50% year over year in the under 40 demographic. That means people are not paying their bills. Auto loan defaults are climbing. Personal savings rates are at historic lows. People are living paycheck to paycheck at rates we have not seen in decades. And here is why this matters to you, even if your finances are solid. Consumer spending drives 70% of the American economy. When consumers stop spending because they are broke, companies lose revenue. When companies lose revenue, they cut jobs. When they cut jobs, more consumers go broke. And the cycle feeds itself until something breaks. You feel this already. You see it at the grocery store, at the gas station, in your own budget. Prices are higher and your money does not stretch as far. But the media is not connecting the dots. They talk about inflation, they talk about jobs, but they do not talk about the breaking point. The point where people cannot absorb any more price increases, where debt becomes unsustainable, where something has to give. And we are there, right now. The consumer is tapped out. Savings are gone. Credit cards are maxed. The buffer is gone. So when the next shock hits, whether it is geopolitical or economic or something nobody predicted, there is no cushion. And that is when the quiet crash becomes loud. That is when everyone starts asking how they missed the warning signs. But you are not going to miss them, because now you know what to look for. You know that when the yield curve inverts, the bond market is warning you. You know corporate debt is a ticking time bomb. You know the consumer is breaking under pressure that headlines refuse to acknowledge. And you know what that means for the market. This is not about fear. This is about awareness, about making decisions based on reality instead of headlines. So what do you actually do with this information? Let me be clear. First, build a cash cushion if you do not have one. 3 to 6 months of expenses sitting in an account you do not touch. Second, review your investments. If you are heavily concentrated in high-risk or high-debt companies, consider diversifying. Third, reduce unnecessary expenses now. Not because you are in crisis, because when crisis comes, you will have room to maneuver. And fourth, trust what you see in your own life over what headlines tell you. Your grocery bill does not lie. Remember when I asked if you felt like something was wrong, but headlines said everything was fine? Now you know exactly why. The yield curve, corporate debt, consumer breaking points. These are not theories. These are patterns, and patterns repeat. The quiet crash is not a new phenomenon. It is the same story with different actors every decade. The only variable is whether you see it coming, whether you prepare, whether you protect what you have built. Here is the big picture. Everything I showed you today is connected. The bond market, corporate borrowing, consumer debt. They all feed into each other. And when one domino falls, the rest follow. Not might follow, will follow, because that is how the system works. So, here are your two paths. Path 1. You take action today. build your cushion, adjust your portfolio, reduce your risk. And when the market corrects, you are positioned to survive it and take advantage of opportunities others miss because they panicked. You walked in here feeling like something was wrong. You leave knowing exactly what it is. And that knowledge is something nobody can take from you. If you learned something today, hit subscribe and drop a comment below. See you in the next one.